what's up, everybody? This is Justin Daniel Finance. I am Justin Daniel, and thank you so much for tuning into the channel. Really appreciate you being here today. And today I have a company that has some really cool medical technology for the world of diabetics. They have a continuous glucose monitoring system that's the first and only implantable and transmitting device for the world of glucose monitoring. So if that's something you want to hear about, please do go ahead and stick around for this video, because I'm going to get into the details about what this company is, talk about their products, talk about the price of the stock, and all that good stuff. First, I do have to say real quick that everything here is entertainment purposes only, nothing's financial advice. But if you're interested in these kind of videos, this is a new channel, and I'm going to continue to bring content and information and news and updates about companies like this and other companies that are in my stock portfolio or companies that I think are worth talking about. And if that's the kind of thing you're interested in, I would greatly appreciate if you would go ahead and hit the like button and also hit the subscribe, because that will really show the support for the channel and help the channel grow into the YouTube algorithm, so I can continue making more and more videos of stocks that I think are worth talking about and taking a look into. Now, with that out of the way, let's talk about the company today that's called Senseonics. Ticker symbol is SENS. And Senseonics is a small cap company, currently has a market cap of under $1 billion. Share price is currently trading, less than $2 per share. If we were to zoom out over 6 months for this stock, we could see that back in December of 2020, it was like 40 cents per share. And then it really exploded over the next couple of months. It hit a high of over $5. So if you're somebody who got in December or earlier and you're a swing trader, you really could have made a killing on this stock just by buying and selling at the right time. Now, it hit that high and it's come back down to under $2 per share, which I think is a more reasonable price area, still kind of pricey based on the market cap. I'll get into some of the numbers and reasons why, but that's where it's at right now. Let's talk about what the company is. Senseonics is a medical tech company, as I mentioned, that has developed the first and only in the world of continuous glucose monitoring, or CGM for short, a device that's able to be implanted, and then it will transmit data about your glucose levels to a smartphone app every 5 minutes. So how cool is that? I'm not a diabetic, but I can tell you that my understanding was it used to require a pinprick where you would have to stick a needle into your finger, and then that's what you do to find out what your blood glucose is. So if you were to ask me if I want to stick a needle in my finger every day, or just have this device that goes to a smartphone every 5 minutes and can give you those alerts about whether the levels are too high, too low, whatever the case may be, I think that is just really something I would be interested in. I would imagine most people would. Right now, they have FDA approval in the USA for SENS, which is a 90-day continuous monitoring product. So I understand that you need to change that out every 90 days. They also have SENS XL, which is the next version. That's 180 days. And that is ready to go in Europe at the current moment. But in the United States, it needs FDA approval for that. And I think it's going to be upcoming here in Q3. I personally am confident that they're going to get that FDA approval. But, that's not a guarantee, and that's not advice. That's just my opinion, but I think they're going to get the FDA approval. So something that was really good for the company was this partnership with Essentia. And Essentia is a much bigger company. They're in the world of glucose monitoring, and they came in and helped provide some cash to give Senseonics that liquidity that really was helpful at a time they needed it. So, getting that cash out there and that liquidity was really good, but they're also able to help partner just for the commercialization of the product, okay? Because they're a bigger, more established company. Not only are they providing the finance, but also that partnership to help commercialize. So I like to see something like that for the smaller company that was in the, the growth startup phase, looking to really ramp up. And as they look to ramp up, they're going from 10 territories in the US to over 25 territories in the US, looking to really ramp up the head count, and really expand the product. And also they have new products in the pipeline. So you can see here year over year, by 2023, they're looking to get beyond that 90-day, beyond that 100-day, but get to that point where it's 365-day product. So that means you don't have to go out and replace it every 90 days, every 180 days, but just once per year. So I think that was something that most patients would be very much interested in. Also, we can see they are really looking to ramp up the global net revenue. So we're talking about an estimated 2021, somewhere between $12 to $15 million for net revenue, but we're talking 2025 of $200 million. So that's really big growth potential. That obviously depends on management's ability to execute on this and really grow with what the expectations are, but that's what they're saying for their expectations right now. now. And that's a lot of growth that could have a lot of benefit for shareholders. And that's good because not only do you have the FDA approval, yeah, you're the first and only. And, first is really good because they have something that's known as the first mover advantage. And that's something that you always really want to have. If you're the first to the market with a product and you have that first mover advantage, that's definitely something that's strong. Now, in terms of being the only, that's also something that's really great. However, unless they have super strong patent protection, which maybe they do, I don't really know about the level of the patent protection or, what the competitors can do to make a similar product. But without, an ironclad patent protection, bigger competitors out there can come in with a similar product, and with more capital and a bigger sales team, they can always try to take more market share away. But having said that, being the first and only right now is definitely something really great for Senseonics. So let's take a look at their earnings. In terms of revenue, they did beat revenue, which is always good to see. And year over year growth was over 7,000%. But they did miss on earnings per share by a little bit. I'm not super concerned about it because in the year of COVID-19, I don't believe that there were a lot of people out there going directly to their doctor's office for non-essential things. And especially if you're somebody who's a diabetic, because I believe that was a comorbidity with COVID-19. So would you really want to risk it? Or would you say, hey, I'm going to stick with whatever I'm using right now, and I'll go see my doctor when everything's back to normal after the COVID-19 is kind of blown over? And so I think that's where we are today. So I think we can look to future quarters earnings as a better indicator than compared to, the Q1 and the 2020 earnings. Here we see an article from Investor Place that says Senseonics stock will likely rise on the same trajectory as Dexcom. And Dexcom is a bigger company in the glucose monitoring world. I think they have Nick Jonas as one of their spokespersons. And it says SENS stock could rise 5 to 10 times over the next 5 years once it receives FDA approval. And as we talked about, I'm pretty sure, at least personally, I think they're going to get the FDA approval. So, it says that Dexcom is a much larger company whose stock has risen 21 times in the past 10 years. So, that's really cool. And if SENS is likely to move up 5 or 10 times in the next 5 years, that's a pretty good investment thesis from this particular author on Investment Place. He goes on to talk about the liquidity fears being relieved because, as we mentioned about the Essentia partnership, that even though the stock went down from a high of 527 all the way down to where it is today, it looks like it's quite a tumble. But the reality is they've got $187 million cash on the balance sheet as of January 31st, which is up $18.2 million from the end of 2020. So that cash is really good, and the partnership is really good. We're talking about that investors can see the stock to move higher as the company goes through these sets of catalysts. In addition, doctors are freer to schedule surgical implants, and that's what I mentioned as well. So that's going to help with the revenue climb as well. So basically, at the end of this article saying what to do with the stock, and if you look at the pathway that Dexcom took over the past, look at the past 5 to 10 years, then we can see the market will warm up to Senseonics. So look to take advantage of the recent dip in SENS stock with a view toward its potential long-term trajectory. However, it's not necessarily the case that everybody is so bullish as that last article. And while Investor Place does have some other bullish articles, I wanted to provide from the same source, Investor Place, a bearish case, because I think it's always important that we consider both sides when we're doing our due diligence and determining whether this is a good stock for our own risk-reward appetite. This article here says if you do the math, Senseonics makes no sense. The market is speaking loudly and clearly, and you just need to listen. And so he's talking about that even though the science of this is brilliant, potentially as a portfolio booster, it might be a disaster, according to this author. He says that he would encourage to continue selling and maybe taking some profits off the table while you can. Of course, taking profits depends on what your entry price and your dollar cost average originally is. And, he acknowledges that he might get hate mail for this, but really he refers back to the article we were just looking and says, is it possible? Yeah, it's probable, but, the market doesn't agree. And what he really goes to look on is high risk, low probability. Talking about the bid to ask spread is what he really starts to look at here. So he's looking at comparable companies like Abbott in the same kind of space for diabetics and glucose monitoring and saying, look, the bid ask spread is really good, which means to say that there's more buying, an indication of more buying than selling. And also the same with Dexcom, which is the company that we compared to, and saying, look, there's more shares available at the bid. bid and the ask at these prices, implying that Dexcom will move higher. But unfortunately, he says Senseonics is a completely different story. There's more shares available at 191 ask than there is at the bid. So that means that there's more people trying to sell than buy. So that's kind of the case that he's bringing here and saying, look at the math and not at the feelings about whether the science is really good, but what do these bid ask indicate? So I just wanted to show you that, this particular author is giving the bearish case saying that he's going to stay away. All right, there we have it, everybody. We've heard a little bit about the bullish side. We've heard a little bit about the bearish side. I've given you my own thoughts and opinions about the company. And again, I do have a small position in the company, only about 1%, so nothing huge. I might add a little bit more because I do like the technology. It's very cool, and I know that it's helping people out there. But my own personal opinion about medical technology and biotech kind of companies is that they're potentially a very high risk reward kind of situation. So I keep smaller positions so that if some of the stocks do skyrocket, it will be great. But if they implode, it's not going to hurt the overall portfolio too much. And that's just the way that I look at it. But I encourage everyone else out there to do your own research and choose what kind of portfolio balancing, diversification, and risk reward makes sense for you personally. But I hope that everyone out there enjoyed this video. I hope that it was entertaining, interesting, maybe you gained something from it, and I hope that we all make some money on the stocks out here. And if you do like these kind of videos, again, I'm going to ask if you'll go ahead and please hit the like and hit that subscribe so I can continue bringing videos of good quality stocks, about stocks that I think are worth talking about for everyone out there. And I really do appreciate it, everybody. You're really awesome for watching all the way through to the end. I can't thank you enough for doing that, and I hope to see you back for future videos, because I'm going to continue making videos about good companies like Senseonics, others in different industries, different fields that are in my portfolio or otherwise. So please stick around for future videos. Guys, thank you so much. I really do appreciate it. I am Justin Daniel. This is Justin Daniel Finance. Here's my Twitter handle if you do want to follow me there, because I also do post when I drop new videos. If you don't have the notifications here, you'll see my tweets and also other tweets about things going on in the stock market that I share on a regular basis. Now, with all that said, thanks so much everybody out there. Until the next video, I hope that you all enjoy the rest of your day. I hope we all make some money in the stock market. And until next time, this is Justin Daniel Finance, and take care.